Guys, the world is literally insane right now. With Russia's invasion of Ukraine, Elon Musk buying Twitter, and Rishi Sunak becoming Prime Minister in the UK, there's a lot going around the world. And then there's the huge fat elephant in the room, inflation. In a political and economic climate like this, should you be investing in the stock markets? Well, in this video, I'm going to break down why you should, using the advice of pretty much the best investor in the world in history, Warren Buffett. If that sounds good to you, smash that like button down below and let's dive straight into it. First, let's understand the context. So last year, interest rates were at all-time lows and the stock and real estate markets were skyrocketing in September of 2021. Yields, which is just a fancy way to say interest rates, on 10-year government bonds were hovering around 1.25%. The tech stock-heavy Nasdaq was over 15,000, having more than doubled from its March 2020 lows. And the real estate market was probably the hottest it had ever been. Lines for open houses in some cities literally stretched outside the door and around the corner. The average price of a house in the United States was up nearly 20% over the past year, and some especially hot markets were up north of 30 to 40%. But boy, do things change quickly in the world of investing. The biggest driver of this change has been skyrocketing inflation. The inflation rate in the United States has crossed over 8%, a level that has not been seen in 40 years. In order to get this inflation under control, the US Federal Reserve has been forced to raise interest rates at an unprecedented level. The yield on 10-year government bonds has tripled and is now hovering at around 4%. This has sent shockwaves through the stock market and real estate markets. The Nasdaq is down roughly 35% from its highs, with certain previous high-flying tech stocks down to 50, 60, and even 70% from their highs. The previous red-hot real estate market has even cooled off as the average mortgage rate has gone from 3% all the way to 7% with no signs of slowing down. Okay, now that we've discussed the background, there's the question that's going off in all of your minds. How can we invest at a time like this? Well, this is where I turn to Warren Buffett. Warren Buffett is widely considered the greatest investor of all time. At the age of 92, he still serves as the CEO and chairman of Berkshire Hathaway. Since taking over the company in 1965, Buffett grew the value of the stock at a compounded annual gain of 20.1%. For comparison, that's nearly double the 10.5% annual total return over the same time span. This difference may not seem massive until you realize the power of long-term compounding. To put it into context, every $1,000 invested into Berkshire would have turned into $36.4 million. That difference is literally immense. So how does Buffett do it and how can you? Warren Buffett's greatest advantage is his fundamental understanding of the value of investing. He knows that stocks are not just prices and charts, but an ownership stake in a real business. So you need to think like a business owner when investing. Much of Buffett's success has come from investing in companies with sustainable competitive advantages and holding them long term. These are businesses with wide economic moats that generate real cash flow. Buffett then uses the earnings and dividend payments to reinvest and acquire ownership in more productive businesses, and this creates a significant compounding effect over time. Although Buffett's company, Berkshire Hathaway, does not pay out dividends, it sure does love receiving them. In 2022, their public stock portfolio is expected to generate over $6 billion in dividend payments. That's $6 billion in 1 year. This is on top of all their operating income from fully owned businesses like the BNSF, Railroad, Furniture Mart, etc. Events like the 2022 stock market crash may have you feeling down on investing. Negativity is everywhere you look in the media, but this is not the time to lose sight of your long-term goals. The reason I'm making this video today is to help refocus our community on some fundamental investing principles. There's no one better to help with that than Warren Buffett. Warren Buffett is what's known as a value investor. This method of investing is where you aim to buy stocks that are trading for less than their intrinsic value. This seems simple, but there's quite a lot more to it. Even the great Warren Buffett has seen his investing style evolve significantly over time. He went from trading what he called used cigar butts to becoming a long-term business owner. This transition to focusing on the quality of the underlying business was largely influenced by his investing partner, Charlie Munger. The importance of quality was best learned through their investment in See's Candies. They weren't initially going to invest into See's Candies because they didn't want to pay more than what they had offered, but then took some constructive criticism and decided to change their minds. Walking away from See's Candies would have been a terrible idea for them because in 1972, Berkshire Hathaway bought the entire company for $25 million. That year, the company had $31 million in sales and made $2.083 million in profits after taxes. Based on Buffett's valuation of of See's Candies, he was initially unwilling to pay more than the $25 million he offered, and that would have proved to be a silly decision. As of 2007, See's Candies had earned Berkshire Hathaway $1.35 billion in pre-tax earnings. So based on this, it was irrelevant whether they initially paid $100,000, $1 million, or heck, even $10 million more. Since then, in 2019, Buffett said that See's Candies has produced well north of $2 billion in pre-tax earnings and that the chocolate company remains a cash cow for Berkshire Hathaway. See's Candies exemplifies what Buffett looks for in a business. The company has built a competitive advantage through significant brand and customer loyalty. Buffett has even said that long-term competitive advantage in a stable industry is what we seek in a business. If that comes with rapid organic growth, great. But even without organic growth, such a business is rewarding. We will simply take the lush earnings out of the business and use them to buy similar businesses elsewhere. This is exactly what he did with See's Candies. The company had limited potential for scaling, but was able to provide a reliable cash flow. This mindset of buying great businesses at fair prices would bleed into all of Buffett's future investments. Now, some of you may be thinking, what does this have to do with the here and now? Well, what you want to do is take forward Buffett's mindset when it comes to investing, even in times like these. Buffett says that interest rates act like gravity on stocks. As interest rates rise or fall, you have to adjust what you consider to be a fair price for any given stock accordingly. He also says that you have to be okay with short-term volatility. Volatility is really just a fancy word for saying how much the price of a stock moves around from day to day. During periods of increased uncertainty about interest rates and the broader economy, those movements and stock prices become even more dramatic. Just look at a chart of the S&P 500 stock market index over the past year. Look how much the stock market has bounced around. I agree with Buffett that it is impossible to predict the day-to-day movements in stock prices. A stock you own may be down 3% tomorrow for what seems like no reason at all. Stocks can fall 10, 20, or even 30% for reasons that don't really make any sense. To someone who's focusing on the fundamentals of the business, one tangible piece of advice on how to be okay with short-term volatility is to only check your stock portfolio once a week or once every 2 weeks. This helps you ignore some of the short-term volatility in stock prices, and this leads us on to another lesson, and this is the most important one. Invest for the long term. Buffett says that periods of high interest rates can be some of the best times to buy stocks. In the early 1980s, interest rates were at the highest levels in the history of the United States. Stocks were getting pummeled. In light of this, people would have said that you would have been crazy to buy stocks at this period of time, but this turned out to be one of the best periods in the last 100 years to buy stocks. A $1,000 investment in the S&P 500 in the year 1980 would have turned into over $100,000 at the beginning of this year. This just shows the power of investing for the long term. So there you have it. You should be investing in stock markets right now regardless of short-term volatility, but only by following a sound strategy with a long-term goal in mind. If this video helped you out today, be sure to like, comment, and subscribe with notifications turned on so that you never miss out on the best advice to become stronger at handling personal finance and investing. I'll see you in the next video.